Hello, everybody. I'm Kai Hoffmann, the CEO of Oreninc.com, and I'm joined again today by Mickey Fulp, the Mercenary Geologist, and Paul Harris, our staff writer here at Oreninc. We're going to talk about what's happened in the last couple of weeks in the markets, but also have a topic picked out for you today in seasonality. Hi, Mickey. Hi, Paul.
Hello,
Hi,
Kai. Hello, Paul.
Hi, Mickey.
From three corners of the world here, three continents. That's kind of cool.
I'm based in Germany. Paul is in Colombia, while Mickey is still up in Vancouver. Shoveling snow, I'm assuming.
Well, luckily I live on in a high-rise, so the snow is probably 100 meters below me right now. So.
But that brings me also to the start of it. We've actually, since our last interview, we've looked at, or we've seen a very exciting couple of weeks here. Gold just earlier today, it was trading at a 3-month high just a few hours ago, actually. Silver is up almost $1 since we last spoke on January 26th, and while the base metals are more trending lower in recent trading. Also, financing activity has massively increased. Our index shows shows momentum to the upside here. It's been picking up ever since the beginning of the year, and in the last couple of weeks, we've seen, for example, Fortuna Silver close or open and announce an $86 million bought deal. JDL Gold announced a $27 million placement in conjunction with its merger with Luna Gold. And quite frankly, I'm really excited to see our index come out on Monday. I don't have the numbers in front of me yet for this week, but I'm assuming, my gut tells me we might see a new record in terms of closed financing or dollar amount of closed financings.
Well, I would comment that it's deja vu all over again. Go back and look in January of 2009, which was the beginning of the second leg of the 2000s to 2010s bull market, and we saw a similar thing in January of 2009. So it's, in my view, the beginnings of a bull market for commodities and the junior resource space.
No, it definitely looks like it, and by the look and feel of it, especially this week, it feels like all of the bought deal financings have been increased in size. I'm still scratching my head here whether that's a marketing stunt, a well-coordinated one by all the mining companies, or whether there was really that much liquidity on the sidelines just waiting to be pouring in now. So it's like we've seen Cisco Mining increase its private placement, or its bought deal, to $52 million Canadian, while at the same time doing a $30 million flow-through financing, which is probably the most significant deal out there this week. You touched on it, Mickey. And is it seasonality? Is it we've been seeing increases in activity over the last few years in the first couple of months, or is it seasonality? Is it the perfect storm for mining companies right now with the increasing gold price as well? Or what's your take on that? And Paul, feel free to weigh in as well, of course.
Of course, yeah.
Well, I think it's all of the above, personally. Certainly, there are companies out there that commonly will announce private placements when they know that they have the ability to raise more money. And it's not only in gold space, I should say. UEC did a private placement, announced at $10 million, grossly oversubscribed, closed that financing at $26 million, so 250% more than they announced. But yeah, it's and also you touched on it, and this is kind of my current ball game is the seasonality of these markets, and commonly this is the best time of year to raise money. There are a variety of reasons for that we don't need to go deeply into. Prior to PDAC, when you should have your financings completed and ready to promote the company at a booth at PDAC. That's part of it. Most of these companies operate, spend money during the North American field season, so they're raising funds to prepare for that. And we've got a rising gold price over the last, let me look at my charts here. Since basically the third week of December, right before Christmas, we have a rising gold market. But bear in mind, as I'm looking right now, gold's at 12.31. It's come off quite a bit today from 12.44, let's say, but it's going in stepwise rises, which is the kind of market we like to see. Bear in mind, though, that the Friday before Trump was elected on Tuesday, gold was at $1,305, so it's still off, 7 or 8% or so since that period of time. So the Trump effect has been very good for base metals, been very good for palladium, which is necessary in the auto industry. Most of the other precious metals are down, and of course it's been especially good for the major U.S. markets.
Can I just sort of come in with something there? The gold's just pulled back in the last day or so again, so it continues to be sort of very volatile. And obviously one of the mantras of exploration development companies is, under promise and over deliver. And it seems the financings you mentioned, Kai, are sort of evidence of that. And do you think it's also a symptom that, the companies, the confidence isn't fully there yet, so they're not going out for the necessarily stating they're going to do a big raise? They're going for a more modest amount, and hey, if we get more than that, great. Because obviously it looks very bad if you try and raise an amount and can't get all of it.
Boy, that's a point well taken.
That is a very good point. I personally, just my gut tells me that they're almost overwhelmed by the interest. Just talking to companies here again, they're looking, because they're still coming from lower levels than they were, in last summer, where they're having to raise money right now, and so they're kind of how you call it, or how you best, they're kind of defensive when it comes to raising raising money. So the confidence regarding financings, whether that's the area, is actually a really good point. Because I think, or just looking at the numbers again, a lot of the junior companies are still raising money below the summer levels of the summer 16. So dilution for them was still a factor, and just uncertainty in terms of whether the money would be available. And I think just looking at the sheer amount of bought deals or private placements that are being increased, that they're overwhelmed by the interest that's out there. And we could have, looking back, it's always easier to talk about this, but we could have seen this coming by the massive decrease in volume and liquidity in the markets over the last couple of months in 2016. That money was on the sideline, and probably President Trump was, or the election, the U.S. election was probably one of the main reasons for that. Just the uncertainty in the markets that for this money being on the sideline, I think. Seasonality you mentioned, Mickey, earlier as well, and I just want to touch on that again. Is a big factor, but it might have been, or it might be actually increased now, or seasonality might, fueled by just the sheer amount of money that is actually on the sideline.
Well, certainly it's an add-on effect, and I don't know if I clarified the seasonality issues, but I will emphasize those again. And commonly, we look at a rising gold price in the first part of the first quarter of the year. That's very common, and we showed that recently in some of my writings. And then the bump that the Toronto Venture Exchange gets in the first 2 months of the year prior to PDAC is quite astounding. Generally, it's one of the best times for the market. And once again, there's a variety of reasons for that we can speculate on or even have some confidence in. But the fact remains it occurs. So those are all add-ons. Concerning Paul's point that the investors are still cautious, or speculators are still cautious, I think that's probably the case. The height of the gold market was in the month of September, when gold closed was still above 1,300, and then we had this pullback, a correction essentially. It went all the way back down to 1128 if memory serves. That's a pretty good correction. I think that was needed, but there is so much pent-up demand with money still sitting on the sidelines, and we saw that coming out. I noticed it, and Kai, you may have too, and Paul also, because we were all at the Precious Metal Summit in Beaver Creek in the third week of September, and the amount of money walking that represented on the floor of that conference was something I'd never seen before. Just astounding amounts of money available. And so there was a little bit of shock and awe that came in when we had that pullback in the gold price. And so that money is probably more cautious now than it was then. And I should also mention, let's just compare Cisco. In January, late January, if memory serves, the timing is where memory needs to serve here, not the amount of money that was raised. But Cisco raised $400 million in late January of 2009. Compare that with Cisco's raise now of 52 million, or 52 plus 30, $82 million. So I don't look at this rebound as full blown on right now. And that was led in January of 2009 by a Barrick financing that was well over $1 billion. Newmont came in, and if memory serves, took on a bunch of debt at that period of time. So the majors led the way in January of 2009. The bigger juniors, Cisco, a good example, followed suit, and then that trickled down very quickly to the juniors. So I'm hopeful that's what we're looking at now.
I've got your point about we're at the start, which seems to be at the start of another bull market, and I think that could be a very sort of key thing. If you go back last year, 2016. The market in the first 3 months was relatively quiet. The traditional lift in January, February didn't happen until after PDAC. And then when it did go, the gold price, for example, went up very quickly in about 2 weeks and then sort of stayed there. So could there be an element this year that people are expecting, the bull market starting, people expecting gold to jump, so people want to invest now and not miss out like they did last year? Because stock prices went up, 20, 30, 40, 50, 100% in a matter of weeks for a lot of companies. But a lot of investors missed that because, I don't know, they're getting over their PDAC hangover or whatever. So perhaps this year people are trying to, deploy capital to avoid missing out if the market suddenly jumps significantly.
Yeah, regarding gold, gold was a year ago, January 29, 2016, gold was 1118, and I think it hit a low in a week earlier at 1082, something like that. So, and that was essentially the bottom of the market, and so people were ready for something to happen. We had this rising gold price, which set the gold stocks, especially the producers, on a roll that probably they got overbought. They went up too far too fast. Now I think caution is the better part of valor in this market. I think personally that the price of gold is going to be very much tied to the U.S. dollar. We talked, I think, last time, a couple of weeks ago, about the correlation of gold and the U.S. dollar since Trump was elected, and it was above 0.95. Now, that correlation has come off over the last couple of weeks, mainly because gold and the U.S. dollar are strongly correlated when the dollar is moving up or down fairly quickly. And so we have not seen the volatility in the U.S. dollar for the last couple of weeks. It went a week ago. It went below 99 for the first time since right after the Trump election. And it's settled into now it looks into the plus or minus $100 range. And I personally am comfortable with the U.S. dollar in that range. That probably will not be a big effect on gold if the U.S. dollar is not volatile, either on the upside or downside. Personally, I'm very happy with the price of gold because if you look at the chart just look at the chart since, say, a 6-month chart, and it's stepwise moves. So it's 2 steps forward, 1 step back. And personally, I find that pleasing to the eye. And we all know how markets work, and we don't want to see exponential rises ever.
We're sort of coming to the end of our interview session here for today. And one point you touched on, Mickey, briefly is the point of you're cautioning investors at this point. And I think it's actually the investors need to be cautious because it feels like a lot of loose money is coming into the market right now because of the point Paul mentioned is they missed the first run-up last year. And
right.
Now they're greedy. So I think we can all agree on the point that the markets are doing really well right now. That interest is definitely there. Gold prices, I think we're all happy where gold price is right now. I don't mind, a higher price, but I think if gold miners can make money at $1,250, should they even be in the business? That's my take on that. And maybe as a last word to that, I'm really looking forward to our index coming out on Monday. I know I mentioned that before, but it's going to show that we're really trending in this space. And I think we're looking at an exciting at least 2-3 weeks until PDAC. And I've got my fingers crossed that we don't see the usual drop-off like we always, in the years 20, or as far as I can remember at least, was 2012, 13, 14, 15. We always saw a drop-off in the markets right after PDAC. So I'm hoping we can avoid it this year.
Some people, yeah.
No, I just wanted to say thanks for joining. So for joining our interview today and taking the time. And Mickey, couple last words maybe.
Well, some people call that the post-PDAC curse. I think it's just a hangover, so.
Yeah,
it probably is, and I'll tell you actually on March 10th how I feel. So
yeah, exactly.
All right, everybody, stay tuned for our next interview. We're doing this now on a bi-weekly basis, and stay tuned for more. Thank you.